Hello, everyone, and welcome to TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options, and I'll be facilitating this session tonight with Rob Roy. I'll introduce Rob here in just a few moments, but first we need to go over some housekeeping details as always. Quite an interesting market we continue to experience. We didn't really have a follow through day to the upside, so we'll see if we'll have one to the downside. First and foremost, this is our disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this available on our website to be read in full detail there, or feel free to take a screenshot if you like, but that's the main point to take away. So for this session, as you'll see circled on the screen, we only have one method of asking questions, and that's going to be through the Q&A window. We are live streaming to various different platforms. So we're live streaming to Twitter, YouTube, Facebook, and of course, our audience on Zoom. So we are going to get through as many questions as we can at the end. Just keep in mind that the question portion is brief. Rob goes through his 45-minute general presentation, goes through some case study considerations, and then opens it up to a few questions at the end. So again, with all the different platforms we are streaming to, we'll try to get our best to get your question through, but just know if we don't get to your question, it has nothing to do with the validity. We just only have so much time. So with that, take that as encouragement to attend the insiders meeting when there's a 45-minute portion solely based on answering questions, as there will be a much higher likelihood of your question being addressed there. Any support related queries I can handle in the chat window, or of course for any other interaction amongst other attendees, please feel free and encouraged to use that window throughout the presentation. Just be sure to change the bottom from the to part from host and panelists to everyone. That way your message will be visible for everyone on the call. All right, I believe that covers off all the important details. So I'll get out of the way and introduce the man of the hour. That's Rob Roy.
Hi, everyone. Welcome to this week's TradeFinder Live. This is your first time attending through the various media outlets that Zach mentioned. Welcome. There's my picture, if you care for that. Let me give you a brief rundown of how TradeFinder works. We talk about the markets, not just the U.S. market, but the international markets as well. I know a lot of you really interested in trading the U.S. markets. I've traveled the world doing seminars. I get it, but all the securities that we talk about are tradable on the U.S. exchanges, and often there are good patterns detailing other markets that can be traded on the U.S. exchanges. So I invite you to stay engaged as we go through the international markets. We'll then do a review of any case studies that we have closed for our alert service on our alert website, EWOtrader.com. Then we'll go through and look at case studies from past TradeFinders. And the difference, if you're wondering, is here at TradeFinder, we look for case study considerations, but at that point, you're on your own. We just look and see what you want to do. And if you want to follow them, you can. The alert service that we have at EWOtrader.com, we actually guide you from entrance, any adjustments, and exits. So that's the difference. So we'll see if we can find a case study consideration for tonight. And as Zach mentioned at the end, with whatever time's left, we'll go through the general Q&A. That's it. That's how TradeFinder works. So welcome to everyone. All right, let's take a look at the markets. As Zach mentioned, we had a move to the downside. We did this move to the upside that we looked at last week to see if we had any follow through. Well, we managed to close the first gap. Now I call it the first gap, but it's actually the second downward gap, right? So we had the first gap to the downside, then the second gap to the downside. Well, then we had a gap to the upside and a second gap to the upside. And so in the move on Friday, we did close that first downside gap, but then yesterday was kind of a, don't really know what we're going to do day. And then a bit of a reversal day today. And you look at the moving averages and you can see we did close below the 10-day moving average. And that's key. If you've watched any of my videos, you know that I put a lot of emphasis on a second day, a follow through or confirmation day. Will we get that? Will we get the follow through to the downside and start to head down towards this wave 5 that's in the tap box? Notice that even though we've labeled a wave 5 in the 5-wave impulse pattern, the tap box still exists, meaning that the software is saying there's still a potential for a move to the downside and lower lows. So as long as that stays in there, we respect that. Then we want to look and see, okay, was there volume in today's move? And if you're bullish on the market, the one thing you can take away from it is, all right, we didn't even have average volume today. pretty weak volume yesterday on that kind of ho-hum day, but still less than average volume today on the downward move. Now that could kick up tomorrow. If we were able to have a follow-through day to the downside, we would probably see more volume move in if the market does continue to go through and sell. But note that we're just trying to close the second upward gap. The high there on the 23rd being 378.83, and then the low today 380.53. So we didn't quite close that gap. But then you can look and say, well, we still have this other one here that was really close to getting closed, but didn't get closed. So over the weekend in the SPY update that we did on our YouTube channel, if you haven't visited it, please do so. Elliott Wave Options on YouTube. We talked about which gap's going to get first. Is Gap City all over the charts? 2 downward gaps, 2 upward gaps. Craziness, really. I've been around a long time. I've been doing this for a very long time. Over 25 years, and you never say you've seen everything, because I don't remember 2 downward gaps followed by 2 upward gaps within the same month. That's just not the normal course of business on the SPY. An ETF like the SPY on individual stocks, sure, that can happen, but not in the market in general. So it's pretty interesting. Right now the futures are down 1, so basically flat, so not giving us any indication of what's going to happen tomorrow. So we'll just see, can we bounce off this 10-day moving average and move back up? We didn't make it back to the 50-day moving average. We're still a little bit oversold as far as the separation between the 10 and the 50. You can see the 10 was curling back up. Got a little bit of a setback today. Note when we were oversold here, the 10-day moving average got quite a bit closer to the 50-day, even though it didn't actually hit it. At some point, the 10-day is actually going to touch the 50-day, if not break it. But we could make this lower low first. And there was a comment on our video on YouTube that said, seems like there's more questions than answers. I wouldn't disagree with that. The one thing we know is that we have a 5-wave impulse pattern to the downside that Elliott Wave is just absolutely nailed. The problem is we've got 2 gaps on the way down, 2 gaps on the way up. I don't know which of those gaps are going to get filled first. It's likely all of them get filled. That's what statistics tell us. 94% of gaps get filled. That's what the AI data tells us. So it's very likely they all do, but who knows what order there could get filled in. Think about this for a second. All the gaps could get filled and not affect the pattern that we're in at all. We could have bounced a little bit higher, hit that 50-day moving average, not even reached the wave 4, filled those 2 gaps, and then reversed back down, made the wave 5 low, closed these 2 gaps on the way up, and we fulfilled the 5-wave impulse pattern. All 4 gaps get filled. Nothing changed as far as the pattern. So yeah, I don't know what's going to happen over the next day or 2. And if anybody says they do, they're lying. Nobody knows exactly what's going to happen. It's a pretty interesting pattern in the markets right now. So what we're doing for our alert subscribers is being very picky on alerts, just kind of picking and choosing and being a little bit cautious at this point in time until the market pattern becomes more clear. Once it does, then we'll jump in. I think that's smart rather than a flat out guess. And if you're trying to figure out which of the gaps are going to get filled first, that's a guess, because there's nothing in this Elliott Wave pattern that tells you which gaps are going to get filled. Now, to further complicate everything, let's take a look at what we have here, where with this doji here that existed there on the 17th of June, look at that. Now we have a qualified zigzag to the downside that gives us a C wave extension down around the bottom part of the tap box, down to 337 on the SPY. So it's qualified. It doesn't mean that that's etched in stone that it's going to happen, but it's a qualified pattern, which means when it's a qualified pattern, you pay attention to it and you watch it. So yeah, who knows which way we're going from here. If the VIX was lower, we'd be doing strangles all over the place. But for now, we'll let the market tell us which way things are going to go. And when the pattern becomes more clear, then we will fire out a bunch of alerts. So not much else to say about the S&P, really. So let's go ahead and take a look at interest rates. And we're starting to bounce back to the upside here a bit on rates. You look at the 10-day moving average, and we had broken below it really what we did was come down, and I opined on this over the weekend. Did we just come down to test that wave 3 high, test the 3% on the 10-year? At this point in time, that's what it looks like. Bounce back above the 10-day moving average. And so perhaps rates continue to move back to the upside. I mean, that makes sense with the Federal Reserve. Now, I heard on the financial networks today, see, they're already starting to, this is the stuff that comes out. They're already starting to say that, and they did this last time the CPI was released, but the CPI report was so bad, they had to back off of it. But inflation has peaked, inflation's coming down, and the Federal Reserve is going to stop their increasing pattern, raising rates, tightening, and next year we'll start easing again. Somebody actually said that today. Easing next year? I don't know. I think that's wishful thinking, but we'll see how the Federal Reserve trades it out. But I don't know about getting back to easing next year, maybe towards the end of the year. It depends if they overshoot the mark, which I think they're likely to do on raising rates. But anyway, the likelihood is the 10-year is going to start moving back to the upside. Looking at the dollar, the DX here, we are still in a really nice looking triangle pattern here. And it looked like, let me take these bars off. Let's go back and see where we were on Friday. So let's walk it back. So Friday, we're here, which is still a nice looking triangle. So you're here, or you could draw the lines if you wanted to be a little more short term right there. Regardless, it's a nice tight little triangle of higher lows and lower highs. So just pick where you want to draw the lines. Well, then yesterday looked like the dollar's going to break it to the downside out of the triangle. This is why we always talk about a second day, a follow through, a confirmation day, because today, boom, back to the upside. So in all, those two just cancel each other out. You take all these lines off and redraw the triangle, which is still a triangle. It's just becoming a little bit larger. Note that we really haven't broken out of that upward trend line, and we didn't really break out of the lower trend line. It's just a slightly larger triangle. That's where the head fakes come in, and that's where you have to be patient. And I talk to our subscribers about this all the time, patience. And it's hard to do when you're trading your money, to be patient with the markets and let the patterns come to you. But that's probably the greatest advice I can give anyone is find a technical system that you believe in. And I'm a big believer in Elliott. I have since 2001 because it somehow forecasts the move on the NASDAQ following 9/11. Not saying it forecasted 9/11. I'm saying it forecasted the move in the market that occurred after 9/11. That's what made me a believer. So I've been trading, and that was on September 24th, 2001. I've been trading Elliott ever since that date. And it's consistent and as solid as any indicator that's out there. And people that poo-poo it, to me, they just don't know enough about it. A lot of people think that they can label the patterns without software. If you've seen the Elliott algorithm, it's like 24 pages of mathematical code that Ralph Nelson Elliott wrote. If you can do that in your head, good on you. But I haven't found the person that could do it yet consistently. So you rely on the software and you trust the algorithm, and we do. Is it right 100% of the time? Nope, nothing is, but it's right a lot. And so that's our main technical indicator. And then we have a set of confirming indicators that we use to back up Elliott wave. But right now, as far as the dollar, we're in a corrective triangle, and it's going to break out one direction or the other, and that's going to determine a lot. It's going to determine what happens with metals, etc. So let's go ahead and look at gold, because I'm sure somebody is going to ask about gold. So I'll get gold out of the way, and then we'll go back and look at the rest of the markets. And the key here is that we're still, by your fingernails, hanging on. It's like a movie cliffhanger, right? Where you're just hanging on by your fingernails to that 170 level. If we break that, we're probably coming down to 165 on the GLD. But if we can hold here and bounce back to the upside, which would be a downward breakout of the dollar, then we might be able to relabel this wave 4, etc. But we'll see what happens, but you can see what happened with the upward move in the dollar, downward move in the metals. Let's look at the Dow. So on the diamonds is what we look at. Again, we try to look at the most liquid tradable securities on the US exchanges. For those of you that are watching on the various social media platforms, such an interesting world. I can remember I traveled the world and did live seminars all around the world, and we'd have anywhere from 100 to 300 people in a room. And now we can have thousands of people around the world on a given night. It's, the technology is amazing. But looking at the Dow, you can see big reversal day there. See where we opened and then traded up and down. And we have this first, or call it this first gap or the second gap to the downside, however you want to refer to it, closed and also closing below the 10-day moving average. Very similar chart to what we have on the SPY. And it hasn't always been that way. If you've been with us for a while, you know that there's been some separation between the Dow and the S&P at times, but right now they're pretty much in lockstep as far as what's occurring. Let's look at the Qs. And we had a little bit of conversation last week. Could the Qs be leading us to the upside? And the reason I said that is because they've labeled their wave 5 at 118% extension, further than what's occurred in the SPY or in the diamonds. And so the 61.8% wave 4 correction, I mean, it doesn't get any more Fibonacci Elliott wave than that. And then 118% extension, and we had the gap up. We bumped our head against the 30-day moving average. I think that's more coincidence than anything. I look at the 30-day moving average, which is that fuchsia line, because I know a lot of floor traders and market makers and investment companies look at the 1030 cross. So whether it's a cross to the upside or a cross to the downside, but I don't view the 30-day moving average as a support resistance line. I look at the 10-day moving average for short-term support resistance. I look at the 50-day moving average for trending support resistance. The 30-day is there because of the 1030 crosses. And so I think that's a bit of a coincidence that we hit the 30-day 3 times here and then close back below the 10-day moving average. So it doesn't look like the Qs are any sort of a leadership. Again, if you've heard any of my recordings in the past, it's been my belief, because that's how history works, that it's not just me. I've been around a long time and seen a lot of things. Haven't seen everything, but seen a lot of things. And normally when you have a period of rising rates, it's not good for tech stocks. So I feel like the Qs are going to underperform by the end of the year. They will underperform the rest of the market. I don't think the Federal Reserve is going to be easing by the end of the year. So I think we're pretty safe to say that that's likely to occur. But there was some chatter on the financial networks about the Qs. Hey, they're performing a little bit better, and maybe some of that's over with. Not as long as the Federal Reserve is raising rates. I just don't see how that can play out. Maybe short periods of time, but not over the long haul. So pretty good reversal there. I think it bears looking at volume on the Qs as well, but still below average volume. So you take a look at what happened today, even though the patterns may be slightly different, what occurred today in the S&P, the Dow, and the Qs, all very similar. All right, let's look at the IWM. Last week, we were able to get back above that 190 level, or the 170 level, excuse me, to see if we we're going to head back towards 190. And could we hold it? Well, so far we have. So you take a look at this. Is this the new trading range? 170 to 190. We started off the year between 190 and 210, as you can see back here. And that was the start of 2022, which was different than the 210 to 230 range from last year. And then we broke down here. We got below 170, but we were able to get back above it. But there we are to the downside. Look at that nice doji there on the IWM. So can we hold 170? If we don't, if the small caps give up the ghost and the Qs give up the ghost, the S&P and the Dow are just right behind them. Those markets are not going to be able to do anything without at least some sort of support. And the IWM, I don't think it's going to lead. The Qs, I don't think are going to lead, but you don't want them moving in the opposite direction either. So if we can hold 170 on the IWM, then maybe we can get a little bit more out of the rally. But as Zach mentioned in the intro, that's going to be the key tomorrow. Do we follow through to the downside, or can we reverse from here? As far as the IWM, you want to see 170 hold. So if you're trading that, 170 is your key. That's your number. If it can stay above it, you can stay long. If it breaks below it, then we're likely at some point coming down here to 150. And that could be the new range because it goes right through that tap box, time and price projections, what it stands for. And so we could come down here, find this level of support, and then we bounce back and forth here for a while, perhaps through the rest of the year. But we're not there yet. So let's just go ahead and take this line off. We got to break 170 for that to happen. And so far we haven't. Bitcoin was doing a little bit better over the weekend and then not so good today. We had another consumer confidence report that came out today that wasn't very good. We had the University of Michigan one that came out on Friday, which was terrible, the worst ever. The worst ever. Can you imagine that? I talk about this a lot, in fact, as I've been trading for 25 years, but you never say you've seen everything. And now we've had a couple of things here recently. One was the Dow had never gone down 600 points 3 days in a row. It's done that within the last month. And now we have the worst consumer confidence report ever since they've been tracking it. And that's the great financial crisis. That's COVID. That's everything. Amazing stuff that's going on. So now we're back trying desperately to hold 20,000 here on Bitcoin. Can it do it? I don't know. We only have a 58% wave 5 extension here. And I highlighted, I'm not going to go through this again because it takes time to draw the lines, but I talked about this stair step pattern in the weekend update on the SPY. So go visit that on our YouTube channel. And you can see the talking about that and where we're likely to go if we can't hold 20,000. But Bitcoin is desperately trying. We'll see if it's able to do it at the end. So here we go to Australia and the EWA. This one is really surprising to me. Look how vertical this move is to the downside. And I keep saying this, but if you've heard my recordings before, you know, I don't like it when markets move vertical, whether it's a security or a market, because when things go vertically one direction, they often go vertically in the opposite direction. So if you go vertically up, you likely come vertically back down. Now, one thing I will say is when you go vertically down, you're likely to bounce back vertically, but not all the way. See, what usually happens if you have a vertical move to the upside, you normally retrace all of it on the way back down. But if you have a vertical move to the downside, you usually retrace some of it back to the upside, but not all of it. But I would have expected more than this. Is that all we got? Is 22 going to be it towards this wave 5 low? You know, when you look at this, and I'm a believer that no security in any time frame gets very far away from the 10-day moving average. I'm also a believer that the 10-day and the 50-day don't separate very far for very long. And that's pretty good separation here. So for the fact that the EWA turned back down, are we really going to come down to this wave 5 target here? We haven't even labeled the 4 yet. So if we move down here, that means we're extending the wave 3, which could happen. It happens often where this target's down here. It's in the algorithm. That's a price that the software comes up with for some reason, whether or not there's a bounce to the 4 first or whether or not it's an extension of the 3. But likely that point gets hit. So when you look at this and you see how separated the 10-day is from the 50, yeah, it really seems like, yeah, we should move back to the upside. We should get up and label that 4. We should move back up towards 23, which is resistance, and it's right around where the 4 is. All that makes sense, but you have to respect the fact that we got turned back down from 22 today. So all the more putting into what happens tomorrow. Zach mentioned our insiders meeting that occurs on Thursday nights. That's for our alert subscribers at EWOtrader.com. We're going to have a lot to talk about, I think. Normally, I kind of joke that a lot of times on Thursday nights, like Friday is going to be really important. Well, now it's Wednesday that's going to be important. So by Thursday night, we'll know. So, hey, if you've ever thought about becoming an alert subscriber, now might be a great time to do it. We'll see what happens on Thursday night. We only charge month by month. It's not much of a commitment to kick the tires and see if you like our alert service. You know, give us a shot. What do you got to lose? 1 month, no big deal. So moving back to the upside here, we'll see if we can get back above 22. But and that was a surprising turnaround to get back below the 10-day moving average already to me on the EWA. So let's look at the IWC for EWC, tried to say, for Canada and see what's happening there. Back up to the 10-day moving average yesterday and traded back below it today. So this one's a little confusing, isn't it? Because we're kind of right at the 62% fib corrective level 4, which means 100% extension on the 5. We got to 92%, pretty darn close there. We've double bottom there at, that's not really double bottom, but we tested the low at 33. So can Canada rebound and move back to the upside? Looked pretty good for a while, but we did close back below the 10-day moving average. So I resubmit that what happens tomorrow means a lot. Can we reverse back to the upside and reverse what happened today? Or do we have a follow through to the downside tomorrow? If we have a follow through to the downside tomorrow, that answers a lot of questions. I mean, I thought that was a really fair comment on YouTube of seems like there's more questions than answers. Yeah, I would agree with that. But if we follow through to the downside tomorrow, all of a sudden, I think we have a lot of answers. So we'll see how the market plays out tomorrow. Let's look at India, the INDA, and back to the downside there. Just basically all we did was trade back to the 10-day moving average one day. Again, you got to have a second day, follow through a confirmation day. Didn't have it. Back down to the 10-day moving average and back below it today. So we had the 38% wave 4 correction, which is a 62% extension. But then you can have an extended 5 wave or an extended C wave in a zigzag pattern. And based on what happened today, it looks like that may very well happen in India. And then let's see what's going on in Germany, where we kind of thought that Germany may be having something going here. Nah, not so much. Didn't even get above the 10-day moving average in Germany. So the worst of the charts, at least the other markets traded above it, even though they couldn't hold it. Some got above it for a day, but Germany didn't even get above it for a single day. And so that wave 3 is likely to continue to the downside. And I would say that this target down here is probably in danger of being a wave 3 extension rather than the wave 5. The one caveat here, though, if you really want to be bullish on Germany, see how that 10-day moving average went back to the 50-day here? That's what happens a lot when they separate. We're getting pretty decent separation again. So to see the market move all the way down here first, that would be massive separation between the 10 and the 50. It's hard to imagine that playing out. So from that standpoint, you could say that maybe we're just consolidating here and we can hold this 3 and move back up, label that 4, come back and test the 50-day moving average. That would make sense. To me, it makes more sense than an extended 3 wave, because all that's going to do is create further separation between the 10 and the 50. But if we start to get increased volatility, I mean, that could happen in a very short period of time. And then, if it happens within a couple of days, well, that's not the same type of scenario as coming into August, right? Where we have the entire month of July where we head down and we create wider separation. If we get some sort of an extreme volatility move to the downside and we hit all these wave 5 tap boxes, then that's a different story as far as the separation between the 10 and the 50. It's not as long from a time standpoint, even though it'll be wider from a price standpoint. Right now, the futures are up 5, so rebounded a little bit, but in this market, 5 points is nothing. I can remember a time when if you'd have looked at the futures and say, oh, they're up 5, that would have mattered. Not anymore. Right, so that's the international markets. And for those of you that may want to look at some of the other ones, I'll leave that to the Q&A. There's other international markets that you want to see. I'd like to show you this case study that we closed. This was an alert to our alert subscribers. This is what our website looks like at EWOtrader.com. Every alert that we send out to our subscribers has its own page. It looks exactly like this. This was our time strategy, which is our AI-based strategy. we feel like we're kind of the leaders of the pack. It's been on CNBC and other places about where the future of technical analysis is likely going to be AI based. Well, we've already got AI programmers that understand trading, and we have a working, viable, with a track record strategy based on AI. So it's pretty cool. So it's a calendar spread, which means you expect the stock to stay in a range after it's dropped a bit. So you can see the entry here on June 13th. You'll be able to see there was the drop that occurred in the stock, and it was on an earnings report. That's what that little E means. So boom, boom. And we're down here to 60. And when you have that significant drop like that, you figure like, okay, it's likely going to stay in a trading range. That's where the AI comes in and gives us a scoring on the likelihood. And if the score is high enough, then we send it out as an alert to our subscribers. And in this case, this was a quick one. Now, normally, when we're looking at these time spreads, whether we do a calendar spread, a butterfly, or diagonal spread, we're expecting an average is 21 days. That's the average that we're in these. Some are longer, some are shorter. And you can see this one just dead smack on that 60 level. Look what happened to the volatility. And the reason that I'm showing you that is because you look back and say, well, one of the things that time spreads do is they capture time. One of the biggest enemies of trading options is time value. But these time spreads make time value your friend. But you can see we were only in a trade 3 days and made over 20%. Well, that's not from time. You don't get a 20% return in 3 days based on 3 days of theta decay. What we got was we captured this increased volatility. We sold that in the short-term option in the calendar spread. And as the volatility came down, that gave us the opportunity to close the trade out just 3 days later and make over 20%. So sometimes we get short-term gains, some last longer, some are shorter, but the average is right around 21 days. So it's a good income generating strategy. So that was on DocuSign too. Imagine that. That's a pretty volatile stock. But yet the AI was spot on there and nailed it. So pretty cool stuff. All right, so now let's go ahead and look at some of the past case studies that we've looked at in previous trade finders. We only have a handful that are left. Most of them would have been already closed out, primarily for gains. If you've been watching, our record is pretty phenomenal here on finding case studies for y'all to look at during Trade Finder. This one was on Reliance Steel. We did send this out as an alert to our subscribers, and we've adjusted this to the downside. You can see we came down here. We had a little bit of a bounce. Doji yesterday, bounced back down today, and closed below the 10-day moving average. So at this point in time, perhaps that 5-wave impulse pattern gets disqualified. It's still intact now, but with these breaks to the downside here, we got just a little bit oversold from the 10-day moving average, and then bouncing back up to it. We made the adjustment to the downside because of our confirming indicators. We'll see which plays out. We can reverse it because if it goes back to the upside, there's plenty of room higher there. Well, that's going to determine on how the dollar breaks out. And so taking a look at HZO, we sent that one out on May 17th. And this one was an expected move back to the wave 4, noting that the wave 5 only extended 80%. And at the time we mentioned, if we break there, then we got another 20% to the downside. And we held it once and bounced back to the upside. But now it looks like closing back below that 10-day moving average today. If we get here, then we're probably going to the downside there. So if you're following that one, that's your key. If you can hold 36, you can stay long. If it breaks 36, you want to go short. Mosaic was also one that we sent out to our alert subscribers. And you can see here's where we looked at it on the 24th of May. And we have changed this one to the downside as well. So we have made an adjustment there, traded below the 10-day moving average, closed below the 10-day moving average today, a little bit of a bounce. Same scenario here that we have with Reliance Steel. Both of these looking like 5-wave impulse patterns, but they're also really close to points where the pattern could break down. So we'll trade by what the pattern does. And I mean, it's pretty simple. That's one of the great things about technical analysis. Just do what the pattern tells you to do. You look at Rio here, that was on June 7th, and see that move to the downside there. So your key would have been here when it broke this level. That's when you would have wanted to go to the short side. And if you didn't, you got a second shot here because we bounced back up, tested this level at 65, and you can see it's a wave 3 to the downside now. So you've got plenty of room to go lower from here. So if you're following along with this one, plenty of room to adjust this to the downside. And then last week we looked at VEEV, and I do know that some of you followed this because you posted it on YouTube. And look what happened here with VEEV. So let's just go back, and we were right here at 185, and that was last Tuesday night. We looked at this, and so then boom, a pretty nice move there on the 23rd. Then on the 24th, another big move to the upside there, and yesterday a doji. So if you hadn't gotten out before, that would have been your point to get out. But from 185 to 208, it's a 23-point move. And again, I know because of the postings on YouTube that some of you did follow that and thought, great, thanks. That one was really good. So we're going to go ahead and cross this off the list. It did move back to the downside today, but there's still plenty of profit. I'll just show you today's move. Filled that gap, and I mean, it still could go higher from here, but we're a little bit overbought from the 10-day moving average. We're at a little bit of a support resistance level at 200. If it can break higher, it probably goes to 220. But I mean, you have to start talking about when greed comes in, and greed's not a good thing in the world of trading. So a 23-point move, that's a pretty nice move. That's 15% out of the stock. So if you're trading options with the leverage, that's a great trade. So congratulations to those of you that follow along with that one. And we've had a bunch of those kind of moves over the years here at TradeFinder. So let's see if we can find one tonight. So I'm going to go ahead and go to the pre-computed list here. For those of you not familiar with this software is called Profit Source. It's from the Hub organization, HUBB.com. If you're interested in learning more about it, to me, it's the best Elliott Wave software that exists on the market. I've tried all the ones that I know to exist because I'm a big believer in Elliott Wave. I'm going to use the best software I can find. So for the ones I've tried, this is the best. You're looking here, they created, because we have a lot of our Elliott Wave option subscribers that use it. So they created some pre-computed lists here. Now, the reason to talk about the pre-computed list is you can create your own search. If you have your own favorite indicators, even if it's not Elliott Wave, if you have your own technical indicators that you really like, you can create a search out of them and test it and back test it and go back years, decades, create trading plans with X number of dollars in each trade, all kinds of things that you can do with it. It takes time to run those searches, but the pre-computed ones are instantaneous. So if we look here, we can say, okay, there's a bullish impulse stock, and the ones that say EWO, those are actually my search parameters. So our subscribers get the advantage of utilizing my searches as well if they want to incorporate that into their trading. So Mercury Systems, let's see what this looks like here. Now let's take a look and see if that DMI has triggered yet. Not sure, not quite yet. So what I mean by that is if you're new to the DMI, Directional Movement Index, you can see the ADX here is the black line, and that measures the strength of a trend. The green line is a positive directional indicator. The red line is the negative. That measures buying and selling pressure respectively. So who's in control? The buyers are, because the green line's on top. And then if the ADX breaks above 20 and stays between these lines, then that tells you that a strong trend is underway. At this point in time, if we look at the Elliott Wave pattern, it's in a corrective pattern. It's not on a 5-wave impulse move. So you've got, from basic technicals, some higher lows here. You can even bring that all the way down here and say, hey, we've got a set of higher lows involved here. Let's look at the 10-day moving average. We're above the 10-day moving average, got a little bit overbought on the high and started to get up near this area of resistance. And you can see by those lines, we're kind of forming a bit of an ascending triangle here as well. Now, this goes on a watch list for me. And you're wondering, well, why would you have a result that wasn't ready to trade? Because if you just put in your search parameters that you want the ADX above 20, which is the trigger on the ADX, then you're getting results at 30, 40, etc. And I like to try to catch it as close to 20 as possible. You get a bigger part of the move. So when they show up like this, it goes on my watch list. So I'll just make a note right here, watch list, and it's MRCY. So I will add that to my daily watch list and keep an eye on it and see what it's doing. Does that ADX get above 20? Our subscribers that have been around for a while can tell you that that's important to let that trigger, because look what happened right here is a perfect example. The ADX is between the two directional indicators. It's breaking to the upside. It looks like, all right, here we go. We're off to the races to the upside, but it went, nope, psych. Got right to 20 and moved back to the downside. It has to actually break through 20 to trigger. And that's a perfect example of why you follow the rules. You can look at it now and say, come on, within a day or two, it's breaking above the negative directional indicator. It'll break above 20 and go. It has to actually do it. We need the trigger. We need the official signal. And that's a perfect example of why. So for me, I keep an eye on this one, but it wouldn't be something that we would look at for today. Wow, look, there's only 21 on the consolidating stocks. I don't know if I ever remember that number being so low. 21 consolidating stocks. That's pretty amazing. Let's take a look at, there's nothing on the bullish corrective stocks. Let's see if there's anything out of these 21 that we could consider. So there's the 21 there, and we can also click in the bullish wave 3, and it'll tell us, are there any stocks that are consolidating within a wave 3 to the upside? And the answer to that is no, there's no results. So we take that off. How about to the downside? There's one, Tyson Foods. Remember when food was like, that was the key? That's where the action was. Food stocks, a couple of months changes everything. Now we do have the positive directional indicator trying to move back to the upside here, but as you can see by the ADX, there really isn't much. We've had several days where it's drifted to the upside, and the ADX is like, yeah, no, not really too excited about that. So we could just be coming up here to label the wave 4 for a new move to the downside. But you can't go to the downside when the indicator is telling you the buyers are in control, even if it may only be short term. And you look at this, and here's some old school stuff for you here. There's just a plain old trend right there of lower highs and lower lows. So we're in a downtrend. We're at the upper part of the downtrend. So I'd say we're more likely than not to head lower here. But when you have that positive directional indicator there, it's really tough to go short when you see that. We could go up and hit this wave 4 around 90, maybe break out of that trend line a little bit. You can see there's also technical resistance there at 90, and that's right where the wave 4 is. So maybe it goes a little bit higher, but I think there's going to be a great downside trade on that one. Just don't think it's today. Let that play out and see if these sellers can take control. I'm more concerned with the fact that the negative directional indicator went down than I am the positive directional indicator went up. If the negative would have gone up and it would have been some sort of a balance between buying and selling, even with the buyers kind of more in control, I would have liked that better. But to see the negative go down leads me to believe that there's a decent chance that we go up and hit 90. Now, the market movement is probably going to tell us that 2 3/4 on the futures right now. So really nothing going on after hours. But in a decent market, if the market doesn't really roll over and sell hard, we may very well go up to 90. So I think that's another watch list one there, because I think at some point that could be a really good downside trade. But 91st, I don't know. We'll see. So far, don't really like either one of those. So let's take that off. Now, the other issue that we have is the VIX closed at 28. And I've been a proponent of the fact that I don't really like to put on strangles when the VIX is above 25. The options are just too expensive. So even if we found a good pattern here, the VIX is too high for following along those guidelines, which puts us in a rare circumstance. We've never had a TradeFinder where we didn't have a case study consideration for that week. But at this point in time, I would say this might be a first, because I don't really see anything that I like there. I mean, even if we go through and look at these, I think we should just move to the Q&A, Zach, because if we go through and find one of these, I know they were talking about Alta today on the financial networks. See, the ADX is low, so these are interesting from that standpoint, but the options are just going to be too expensive. That's going to be the problem. Deckers is one. That was a good one in the past years ago. See how that just kind of goes into a trading range. It did that in the past as well. So you got a pretty decent ascending triangle working right here, and you've got a really low ADX. Look at that. ADX is diving down to 12. I like it below 15 when the volatility is higher, and I like it below 13 when the volatility is lower. But when it gets above 25, then we kind of back off. Even the low on the VIX today was 26. So if the volatility in the market was a bit lower, I would think that one is probably okay. But it's going to be an expensive strangle anyway at a $270 stock. Children's Place is another one. Oracle, but Oracle hardly moves. This one doesn't really move either, but it's a retailer. And so retailers are really struggling right now. Nike reported their results, and the results were okay. The guidance wasn't so great, so it was down today, but there's a lot of hoopla that was made out about their top line numbers were good. It's just the guidance that wasn't so good. But maybe a retail ETF, that might be something that you could take a look at. Let's try that. Well, I think that we're just going to move to the question, Zach, and I think we're gonna have to do a pass here. There's gold. The one thing that you could look at, if gold breaks 170, then there's a trade down to 165, as we talked about, but it needs a follow-through day today. So we closed at 169, so we closed underneath 170. If that's what we'll do, we'll mark that one down. So it's GLD. If GLD closes below 170 again tomorrow, so a new closing low tomorrow, then that's your downside trade to 165. So we're going to put a asterisk by that one. It's not an official trade yet unless it looks lower tomorrow. And again, what the dollar does is going to have a lot to do with that. But that's the best looking thing that seen on the charts. All right, Zach, let's go ahead and open it up to questions.
All righty, sounds great. We'll start out with this first one from MD from Zoom saying, can you please look into snow? A 1D chart looks like it is a regular flat and wave C is an ending diagonal and it is completed. My thought, wave 1 is started now and may go up to 180 to complete wave 1. No, this one was talked about a bit earlier on the panels.
It does look that way. I agree with that. The wave 5 looks complete because we had a 38% wave 4 correction, yields a 62% extension. We got that. It's bouncing to the upside. It got above a bit of resistance there at 140, and it's coming back to test that now, looking at the 10-day moving average. So it was a little bit overbought. I would say that there's a good chance this isn't a wave 1. We don't label, or this software doesn't label it until the 2 is intact, till once you start the wave 3. So it won't label a 1 at the beginning of it. You need to have the impulse move, the correction, and then the start of wave 3 before it labels it. But I would say that there's a chance that that's occurring to move back up here towards this previous 4. So I would agree with that, that comment. It looks as good as anything as far as what's underway. 140 is going to be the key. It's got to hold above 140 though. If it breaks back below it, then you have to say, well, it may come down and test that low at 120 again. As long as it stays above 140, then perhaps we do have, yeah, that's a pretty good volume. Perhaps we do have something working to the upside there. We're a little bit, that's an extreme point high on the CCI, so maybe it needs to rest a little bit here. So a really good scenario for this stock would be to consolidate there just a bit on top of 140. It's a little bit overbought right now, short term, according to the CCI. So it hit the 50-day moving average, tried to close or tried to trade above it today. It did open above it. So some consolidation here above 140, let the 10-day moving average catch up, and then you probably have a pretty decent potential move there. But it's got to stay above 140 is the key there. And somebody had written in and asked about when. So I'm going to show that one, Zach. So I'm going to supersede you here on the next one. So we'll look at when, and then whatever you have next on the list. So looking at Wynn Resorts, same thing here, that 61% wave 5 was right at the 38.2% wave 4. Are we going to have all we did was come up and fill that gap and then reversed? See, this is one of the confusing things, because this is gambling. So this is the sin stocks, alcohol, tobacco, and gambling that we talk about. So when the market's not doing well, this is where money likely goes. But you know, when you look at that, if it closes back below 60 again, I would say there's a pretty good chance we go down and hit that wave 5 target at 45. So that would be really what's going on. It seems like this should be hanging in there a little bit better. We got China opening back up again. What's going on here that we're not aware of as far as why this is moving to the downside? This would typically be a stock that's performing well in the kind of market that we're in now. So I don't think that's a really positive sign if this one can't generate something. But if it can hold 60, it's got a chance to go to 70. It's a little bit overbought from the 10-day moving average. But if it breaks back below 60 again tomorrow, it's probably coming down to 45. All right, I'll turn it back to you, Zach.
No worries. Thanks for that analysis on Wynn and the overall feedback on Snow. Snowflake, I know, was talked about a bit earlier on CNBC. I think it might have been on Tech Check. So it was good to hear your insight there. Next up, we'll go over to YouTube. And Will asks, who will lead with tech being such a huge part of the S&P 500?
That's a great question. I don't know. And the issue is really, without the tech sector, the only other thing that you would want is the financials. So if we look at the financials, you would think they've got a chance to be the leaders, right? Because rates are going up, spreads should be going up. But the problem is that financials don't do well in inflation. They do well with rising rates, but not inflation, because that hurts the economy. And if the economy is weak, people aren't borrowing. So it doesn't matter how good the spreads are. If nobody's borrowing any money, the financials can't make any money. And so you can see that that chart looks almost identical to the SPY. But I would say that without tech, and if we don't get the financials either, it's just not a very optimistic picture. But the answer to the question is, if tech can't lead, it's either small caps or the financials. Nothing else really gives you much significant leadership in the marketplace. And we already looked at the IWM. It doesn't look too bad, but it's got to hold 170. So it's looking iffy right now. It really is. Even
No
with that
question here.
separation between the 10 and the 50, which is amazing to me.
Absolutely. So we'll transition back over to Zoom, and Steve asks, why don't we compare or contrast the daily and weekly Elliott patterns as a confirmation validation indicator?
Well, we do. We do a lot.
Thought that's what you might say.
Yeah, maybe not as often as we could. But in the weekend report, I did show the weekly chart. And so if you looked at the SPY, apparently you didn't, because of over the weekend, I talked about the weekly chart on the SPY and the fact that when you compare that to the daily, if we were to come down here and hit this tap box target on the 5, that would bring us probably to a 61.8% wave 4, because it'd be right around that same spot. We have 57%, which you can say is close. It's close, but the fib levels usually at least get touched. Sometimes it goes past them, but they usually at least get touched. It hasn't yet. Yes, 57% is close, and that could hold. But I would say that if the daily comes down and hits this 5 in the tap box, that probably brings the 4 down to 61.8, and then everything is jiving and correlating the way you would expect it to. So yeah, we looked at it in the weekend report.
Very well. Thanks for that, Rob. So we'll go back over to YouTube. Q Trader asked, short straddle or iron condor on the TQQs?
On the Qs?
Yep.
Short straddle.
It was actually the TQQQ, so the Pro Shares Ultra.
Oh, the TQQQ. Well, I see where you're seeing this consolidation here, and we could break one way or the other. I'm not normally a big fan of these ultras because they take futures into account, and that brings you're like doing double time decay. But if you're doing something like a short strangle, where you're selling both sides instead of buying both sides, well, that changes the game, doesn't it? Obviously, understanding the risk, I can see where that's coming from. You got 25 and 35 there, resistance at 35, supported 25. That's a really high risk strategy, but if you had the tolerance for it and you had the account size to cover the risk, it actually makes sense. You've got 25 with the 10-day moving average, you got 35 with the 50-day moving average, you got support resistance at both of them. It makes sense.
All righty, thanks for that, Rob. I see we are at time, so as always, I'm happy to stay on as long as you are. You just tell me.
Let's do 2 more, because since it was struggle to find a trade, and only left 10 minutes for Q&A, so let's do a couple more, 2 more.
Sure, no worries. John asks or says XRT might make a nice bearish trade on retail.
That's the one I was looking for. Thanks. Yeah, it's thanks for sending that in, because that's what I was trying to find. Just had a brain fart there for a moment, but yeah, you've got the wave 5 at 110%. You have this move to the downside here, better than average volume today. I think that's a great trade. So let's add that to our list. I hope people didn't drop off already. But XRT to the downside. I was looking for that. Thank you for reminding me of the symbol. And so yeah, and especially if you break 60, then watch out below. But yeah, I agree. I think that's a pretty good downside trade. See, that was good to go a couple more. I was looking for that symbol before, and I was coming up with XLT instead of XRT.
No question there. And so we'll end on this last one here from George from Zoom. Is the 1030 cross to the downside usually for a longer term than to the upside?
Oh, not necessarily, because what you can see here that the cross occurred, and this is not a good example, right? Because I'm just going to say not really, because there's the cross back there in December, and we kind of kissed it a little bit there, but that really wasn't much of a break. And other than that, it's been pretty much down since then. But normally what occurs is the downside moves are so fast that when you look at the 1030 crosses, when you have a bullish 1030 cross, they usually last longer than a bearish 1030 cross. This symbol, not a good example of what I'm explaining, but that's how it normally works. Just because things usually move so fast to the downside that you don't stay in a downtrend as long as you do. Now, we're in a weird situation right now, aren't we? Because we're in the early stages of a Federal Reserve rate hike. We got the Federal Reserve raising rates into maybe a recession, if not really close. I mean, the estimate is barely a positive GDP, but it could easily be negative and give us an official recession. I know most people say it feels like one anyway. I agree. It feels like we're in a recession, whether it becomes quote official or not. So we're already in a weakening economy, and the Federal Reserve is raising rates and withdrawing liquidity. This could be a little bit longer downtrend than normal. So, everything has its caveats. I would still say in general, a bullish 1030 cross shows a longer trend to the upside than a bearish 1031. But if you find some stocks that are having a bearish 1030 cross now, you might have some pretty good downside trades for maybe the rest of the year here, and until the Federal Reserve gets done with their big rate hikes. So, man, I'm glad we did those last two questions, Zach. Both of them really, really good and really important. So thanks, everybody. Thanks for all of you that were watching on the various social media live streams. We appreciate taking your time. If you haven't heard us before, sign off the same way every time. Very much appreciative of your time, the most valuable asset we all have. And when you devote some of that to us, we try to make it as informative and educational as possible. Thank you so much for your attention. Have a great week. Talk to you again next week. Take care, everybody.